Using market fluctuations to unlock opportunity. Meet the S&P 500 Dynamic Participation Index. Volatility in financial markets often represents uncertainty, but it can also signal opportunity. On a daily basis, asset prices fluctuate as the dynamics between buyers and sellers help establish fair market value. S&P Dow Jones Indices built the S&P 500 Dynamic Participation Index with these fluctuations in mind, to provide investors with a rules-based framework designed to identify and reflect the potential opportunities that short-term pricing dips may present. So how does the index work? The index design reflects, at its essence, a buy low, sell high strategy. It uses the trailing 10-day moving average of the S&P 500 as a signal for when to increase index exposure. If the daily close of the S&P 500 dips below its 10-day moving average, the S&P 500 Dynamic Participation Index will increase its S&P 500 exposure by taking a theoretical leverage position of up to 200%. So it can increase its upside potential when the base index climbs. Once the closing price of the S&P 500 has moved back above its 10-day moving average, the S&P 500 Dynamic Participation Index will decrease its theoretical S&P 500 exposure back to 100% in order to mitigate risk with respect to any downturns, since a leverage position would increase the impact of future dips. So who pays for this leverage? The index does. When the 10-day moving average of the S&P 500 is below the current S&P 500 index level, the S&P 500 Dynamic Participation Index borrows additional funds at the Fed fund rate in order to increase exposure to the S&P 500 and capitalize on potential upside. Since the S&P 500 Dynamic Participation Index is calculated in terms of excess return, the cost of the theoretical borrowing is automatically deducted from the index when the exposure is over 100%. And how is the amount of leverage calculated? The additional exposure is determined by 50 times the difference between the S&P 500 index level and its 10-day moving average, with a maximum leverage of 200%. And how is the index performed? Over the long term, the S&P 500 Dynamic Participation Index has outperformed the S&P 500. Despite its higher volatility due to leveraged positions during some market downturns, the index has also outperformed on a risk-adjusted basis based on hypothetical back-tested performance. For more information on how the systematic design of the S&P 500 Dynamic Participation Index could help market participants understand the potential opportunities inside the daily price fluctuations of the S&P 500, visit us at www.spglobal.com/spdji.